Hello, hello, and welcome back to the Wall Street Petting Zoo podcast, your source for all things beginner investing. I'm Christopher Carroll Smith, and unfortunately, Robert is not available this week, so I'll be doing this one by myself. And just so you guys know, we're actually going to change the way that we do the podcast a little bit. We're going to split into two segments each week. One segment will be educational, and we will cover a timeless topic like basic charting or how to do fundamental analysis. Those will be available on YouTube. You can keep coming back to those videos. They will be useful to you till the end of time. The other segment is going to be This Week at the Zoo, and that will be our look back at the past week and our look forward to the next week. So that one's a little more time sensitive. So we wanted to separate that out from our educational segments so that when you keep coming back to our educational segments, you won't have to listen to our week in review. So here's This Week at the Zoo, and we will get back to our educational segments next time when Robert has returned. So let's just look back at this last week. Man, what a week in the stock market. The bears definitely ruled the zoo this week. It was a big week for the stock market. It ended way in the red, way down. So let's talk about some of the things that happened in the news that dragged those stock prices down this week. The bad news started in before the week even began. So, once a quarter, companies report earnings for that quarter. They release a statement and hold a teleconference indicating how much money they've made or lost that quarter, how much revenue they brought in, etc. And just kind of giving investors an update on the company. And that's one of the major things that moves the stock prices. How well are their earnings that quarter? And so this is closely watched, and there is a company called FactSet that polls stock analysts and asks them, what do you think the earnings for various companies are going to be like this quarter? These analysts are people who have studied the companies very closely, so they're people who are very plugged in to how companies are doing. So this is a great preview on sort of what sectors are going to be hot, which companies are expected to do well, and which ones are expected to do poorly. Now, on Sunday, there was a poll result released by FactSet, and what this poll said was that analysts are expecting really bad earnings across the market this quarter. They're even calling it an earnings recession. And there are particular sectors that are expected to be especially hard hit. There is the tech sector, and particularly the semiconductor portion of the tech sector. Companies that make computer chips like AMD and Micron and Broadcom. These companies are expected to do especially badly this quarter. And we saw that on Thursday after market when Micron reported its earnings. Earlier this year, Micron was reporting that its earnings were going to be weak due to the trade war, but that earnings were going to recover in the back half of the year. We have not seen that. Earnings not only are still weak, but they have actually gotten weaker over the course of the year, not stronger. And they're only going to get weaker next quarter. Micron reported that they expect their margins and their profits to go down next quarter, not up. We haven't seen any recovery from the trade war. Chip companies sell a lot to China, and so they're very exposed to the trade war. So, bad news for chip companies. Mining materials companies are also expected to do very badly. There are a few bright spots. So, healthcare companies are expected to report very strong earnings. We'll talk later about some of the political risks that healthcare companies face. I actually don't think that healthcare companies are a good investment right now because of the political risks that they face. But there are some other ones that are doing pretty well. Software is expected to do very well. IT services are expected to do very well. And utilities and real estate are also expected to outperform in October. So those are all good sectors to be long on in October. I mentioned that I don't think the healthcare sector is a great investment right now. So let's just talk about the news that came this week in the healthcare sector. There's an analyst agency called Citron that released a report on a major pharmaceutical company called McKesson. McKesson, along with Endo Pharmaceuticals, Teva Pharmaceuticals, and several other major generic drug makers, is facing litigation in counties, states, and countries across the world for its role in causing the opioid epidemic. There are people all over the world who have been addicted to painkillers and opioid drugs such as OxyContin, and governments are blaming the pharmaceutical companies that have manufactured, marketed, and sold these products. McKesson's stock price, according to Citron, could get cut in half from its current levels. Right now it's about 135. It could drop to half of that. And McKesson isn't even the pharmaceutical company that has the biggest exposure to this. Endo Pharmaceuticals has the biggest exposure to this. The liability of these companies is in the tens of billions of dollars. It could cause a huge wipeout of several of the major pharmaceutical companies, several of the major generic drug makers in the United States. There's also, of course, political news that we'll talk about shortly that's bad for Donald Trump. Anything that's bad for Donald Trump is probably bad for healthcare and pharmaceuticals as well, because, of course, Donald Trump's chief opponent in the election, Elizabeth Warren, is a proponent of Medicare for all. She essentially wants to eliminate the health insurance industry and wipe out the middlemen in the healthcare industry, which probably needs to happen because, frankly, insurance tends to be somewhat predatory, but it is a very profitable sector, so it would be bad for a lot of American workers, and it would be bad for a lot of American investors if that sector were to go under. And of course, Elizabeth Warren, as part of the Medicare for All reform, also wants to impose price controls on prescription drugs. And so that would be very bad for pharmaceuticals. So this is a really risky sector to be in right now. So let's talk about that political news. One thing that happened this week is that Donald Trump had impeachment proceedings initiated against him. And of course, he released this transcript of a recording of his phone call with the president of Ukraine, which is fairly damning for him. It appears to show that he was withholding defense funding, that defense aid that was promised to Ukraine. He was withholding that in order to sort of extort Ukraine to investigate his political rival, Joe Biden's son, regarding some alleged corrupt dealings that Joe Biden's son was supposed to have had in Ukraine. This is, potentially criminal matter, and it looks like he really could get impeached over this. And as soon as that call transcript hit the market, we saw the dollar shoot up and gold take a plunge. And that's because Donald Trump has been a big advocate of weakening the dollar. So if Donald Trump were to be impeached and removed from office, that dollar would shoot up because no longer will he be pursuing a policy to weaken the dollar. And I actually think that weakening the dollar is a pretty bad policy. So I think it would be probably good for the market as a whole if he stops trying to weaken the dollar. But it would be bad for gold. Gold thrives when the dollar is weak. Gold generally moves opposite the dollar. So if the dollar shoots up because Donald Trump is getting impeached, then gold plunges down. And the same is true of cryptocurrencies, by the way. So if you're a Bitcoin investor, watch out, because the more it looks like Donald Trump is going to be impeached, the more the dollar is going to shoot up and the more gold and those cryptocurrencies like Bitcoin are going to fall down. So, now is a very risky time to own either gold or cryptocurrencies, especially since both of them are up quite a bit from where they were earlier this year. Trump announced on Friday that he is considering limiting U.S. investment in China. So the whole raft of China stocks that trade on U.S. stock exchanges, including perhaps most notably Alibaba, were way down on Friday. We could see serious weakness in China stocks going into next week, assuming that Trump continues with this policy idea that he's sort of floated. But the thing is, Trump floats a lot of policy ideas. He may not actually act on this. And if it seems like he's not really going to do anything about this idea, then we could see those China stocks pop back up. So set your Google alerts for anything related to China stocks and Donald Trump. And maybe you can get in on that pretty quickly if those headlines hit. So let me just close out, now that we've talked about the news, by giving you a few of my stock picks of the week. My first one is Rent-A-Center. This is one that is near its all-time highs. It's got a 9.3 out of 10 summary score, combining all the different analyst ratings. It's grown its earnings by 113% this year. Scored out of 100, S&P Capital IQ rates it extremely undervalued, 99 out of 100 undervalued. It rates it extremely high quality, extremely stable growth, and extremely financially healthy. I mean, you really don't see numbers like this every day. All four of those numbers are in the upper 90s. So this is a really solid stock. It's really got a really good valuation right now, and I think that it should surge even further to even higher highs later this year. So that's one of my buys this week. That's in that real estate sector that I mentioned has been somewhat insulated from the earnings recession. So that's a good stock to be in October, in my opinion. Avaya Holdings Corporation, AVYA is the ticker on that one, is another one that I bought this week. That is a software company. It's down roughly 30% since its IPO this time last year. It's a relatively new stock, but it's a pretty inexpensive stock. It's close to its all-time low right now, and analysts are rating it highly undervalued, and it's got some good catalysts ahead. So last quarter, it reported a big loss, but it was basically due to a one-time, what they call an impairment charge. The company as a whole is profitable. It's got positive cash flow. It expects to report a profit this quarter that's 4 times higher than the same quarter last year. So $44 million this quarter as opposed to $11 million the same quarter last year. It's consistently beaten the pants off of analyst estimates of its earnings. And it's signed a couple big government contracts last quarter. It's working with Intel's AI division to improve the intelligence of its software. It's released some new products that it's going to demonstrate at the Technology Week in Dubai on from October 6th through 10. I think that this stock is probably going to get a nice recovery going into the new year, and I think that it could be one of the big winners of October. And my third stock pick here is Lexington Property Trust. This is another real estate company, another company in the real estate sector. Ticker is LXP. And this one blew away analyst expectations on its last earnings report. It beat by 200%, got a nice pop after earnings, but then it announced a $10 million share offering, meaning it's issuing new shares of stock, which dilutes the ownership share of all the stock that already exists. And so the stock fell there. But then it announced what it was doing with all that money that it raised by issuing new stock shares, which is it's buying new properties. So I'm not too worried about that share offering. I think actually that is going to accelerate the company's growth. And assuming that the company is as good a steward of the new properties that it's purchased as it has been so far of the properties that it already has, I think that this is really going to propel its expansion moving forward rather than diluting my shares. So this company again has a 9.5 out of 10 analyst rating. It's rated undervalued, and it should outperform in the earnings recession because of its belonging to the real estate sector. It's, by the way, this stock pays a dividend of 10 cents per share, and it just had its dividend this week. I actually bought it right before the dividend. And it stayed pretty stable after its dividend. Whereas one of the warning signs that I watch out for is when stock prices drop right after the dividend. This one stayed pretty stable. That's a really good sign for this stock, and I think that Lexington is probably going to do pretty well moving into October. So those are my watches for this week. Hey, all you guys, be safe with your money out there. Don't risk too much in October. October tends to be a really volatile month, and this one is going to be especially volatile with their earnings recession. We can see broad market weakness. If you play the market short, this is a good time to be short in the market rather than long. So just be safe, and you can always take your money out, keep it in cash. The dollar's doing really well right now, and you can get back in November. Hey, that's our podcast for this week. Make sure to like, comment, and subscribe on our YouTube channel. Look for our Facebook and Twitter links under this video and give us a like or a follow on Facebook and Twitter. And you can also support the podcast by following our referral link to Webull, to sign up for Webull. If you sign up for Webull through our referral link, we get a little $5 stock. We get possibly a gift card. Those things help us support the podcast. We're going to just plow money back into recording equipment and editing software so that we can bring you guys the best quality podcast that we can. Thanks so much for your support, and we'll see you next week at the zoo.